Hi, this is Mark with ValueCharts.com. One of my favorite buy and sell signals has to do with bullish or bearish divergences, and at the same time combining that information with overvalued or undervalued price levels. If we look back several days ago in the gold market using the continuous 60-minute gold chart, we can see that this market came up in this corrective mode here and went into moderately overvalued using a 14-bar analysis period on our value bars indicator. And basically after that, we came down back into fair value, and then we once again went higher to higher prices. We can see the high over here with this correction was right at 1731.20, and then we reached a new high, which was right around 1733.70. So this action of reaching new highs, getting into moderately overvalued price territory, and at the same time seeing a lower reading with the MQ momentum histogram is often a very powerful low-risk entry signal. Now, quite often what we end up seeing is we end up seeing the indicator line and the histogram both form a bullish or bearish divergence, or divergence, I should say, with respect to price. But sometimes just seeing the histogram is actually good enough. In this case, this was a higher histogram value with the previous peak, and then the secondary peak we saw a lower histogram value. Now, we talked about in yesterday's gold video on the Value Chartist subscription site the possibility of the gold market breaking down through this lower trend line, which we talked about being fairly well defined. We used the upper trend line as being this trend line right here for the pennant pattern. Gold, sure enough, broke through the bottom. This is another great signal that I often find in gold, because what happens is there's typically, when you see a gold breakdown like this, you see exactly what happened here, and gold tends to really slide to the downside, or if you see a breakout to the upside, you really see a quick spike in gold. And so it tends to represent a very low risk, high return trade when that happens. And in terms of managing your exit from this trade, I would recommend possibly using a drill down MQ momentum indicator. Maybe even 5-minute bars have actually been quite effective in that as well, or 15-minute or 30-minute if you want to go longer term. But the other thing is you can use a value target when the market hits down into significantly undervalued. That's another possibility for an exit signal. Now, what I'm looking at right now is earlier today I saw a bullish divergence form where we saw prices reach a new low. Here's the first low right here at 1698. We saw a new low over here with these price bars at, call it 1692.60. Now, I drilled down from this area and actually ended up buying this for a potential turnaround. Now, all we really saw was a bounce, but I was able to put a break-even stop in and really ended up losing nothing on a trade that was rarely negative, if at all, and that amassed several $1,000s of profits before I was stopped out at break-even. So that's perfectly acceptable to have happen. In fact, let's go ahead and take a quick look at that trade. As I said earlier, what I was looking at is the situation where we were looking at a bullish divergence on a 60-minute basis, and I was basically looking at this market to break out above all these highs on a 15-minute basis, and I pretty much jumped the gun, initiated a long position. Sure enough, the market broke up and went into moderately overvalued, and then essentially started turning back down, and I was stopped out essentially at break even. I think it might have been after the slippage one tick worse, but certainly no problem there. That's to be expected. I expect this market on a 60-minute basis to go back down and break these lows here, which were again at the 1692.60 level, and then we should watch very carefully to see what this market does once that happens. If we begin to accelerate to the downside, we know we have a very weak situation. If the market essentially stalls out once that happens, then we could have a fairly low-risk buying situation where we have a potential bullish or double bullish divergence taking place on the 30 and the 60-minute charts. So keep an eye out for that. This is the type of trading signal I like to take when I'm trading the markets, the bullish or bearish divergences, and also keep an eye out for the trend line breakouts as well. With the gold market intraday, or end of day, the trend lines actually work extremely well in both time frames. That's all we have for this video. We'll continue to track gold. Right now, this market is in control of the bears, but we could see a bottoming and turnaround at some point here, and then look to potentially initiate some long positions for an outlook that would show the potential for commodities to really have a great run over the next couple of years. So very long-term outlook. That's why we need to be very careful about how we enter these types of trades. We're always looking for very low risk entry points so we can maximize profitability and minimize risk. That's all we have for this video. Thanks for watching.